Good
Okay.
afternoon. Good afternoon, and welcome to today's webinar. My name is Helen Hall, and I'm the host. I'd like to go over a few housekeeping rules before Mauro Togneri introduces our presenter. I've muted all of the phone lines, so please keep your phones on mute. The presenter would like me to answer all of your questions at the end of the presentation, so please type your questions in the chat pod to your right. The webinar is being recorded and will be available on our website within a few days. And after the presentation, I will send our participants a copy of the slides. And here is Mauro Togneri.
Well, good afternoon, and thanks for participating in the Business Organization for Engineers webinar, which is authored by David Osfeld and sponsored by the Intellectual Property Committee of IEEE USA. The Intellectual Property Committee objective is to foster better understanding and protection of our member intellectual property rights, whether they're in the form of patents, trademarks, copyright, or trade secrets. David is an attorney with Strasburger and Price, LLP in Houston, and has represented clients for more than 30 years. His area of specialty include intellectual property, international transactions, domestic transaction, antitrust and anti-competition issues, customs, export regulation, contract transactions, technology agreement, and franchise law matters. David has been a member of the Intellectual Property Committee of IEEE USA for over 30 years as a chair, vice chair, member, and he has given testimony and advice to the U.S. Trade Representative, various committee of the U.S. Senate and House of Representatives, the White House and the White House Office of Technology Policy, Energy and Justice, concerning competitiveness, technology, and intellectual property issues for the United States. He is also an arbitrator with the American Arbitration Association and the International Chamber of Commerce. David holds a Juris Doctorate from South Texas School of Law, as well as bachelor and master degrees in physics, electrical engineering, and control system engineering from Washington University in St. Louis. He was a practicing engineer in industry for over 10 years and has been a member of IEEE for over 40 years. So one word before David starts, there is a chat space on the right hand of your screen. Use it as you wish during the presentation. David will see it, and if he thinks he needs to respond, he will. But otherwise, you can also use it to communicate between members of the audience. So thank you very much again, and David, it's all yours.
Thank you. Hopefully I'm not talking to an audience who's been cut off. It's still there. What I'd like to do is first reflect something that happened to me when I first got out of school. Being a young engineer, wanting to be creative, I made some inventions. And these inventions were good enough to where we wanted to start a little business with them. And that's when I learned that in starting a little business with somebody, there are complications as to what kind of organization you have. It frustrated me to find out that there was somebody called a lawyer. I mean, everybody knew what a lawyer was. That was somebody who was on TV defending people in criminal cases. But this was a lawyer in, at that time, Texas, who actually had to organize the company. We had no idea why it was being organized the way it was. When we were told that the person who was organizing it was going to take a piece of the stock, we objected, and at that point started to learn something about business organizations, in that particular case, a corporation. And so I thought I might get you acquainted. This is not a do-it-yourself course, as we talked about a few minutes ago. But I wanted to get you acquainted with the terminology that you're going to encounter when you run into business corporations or business organizations, and especially those in Texas, which is where I'm licensed to practice. What you're seeing on your screen now, the types of business organizations in Texas, are the sum total of all we're going to talk about today. And they're divided into three parts. The first part, the simplest, are going to be the sole proprietorships. The most complex are the partnerships, which are various types, and that stems from what the problem is with a general partnership. And we'll talk about that in just a few minutes. And finally, we'll end up the day with corporations. And I want to thank Daryl for telling me that at least one member of the audience is still there. Anyhow, the type of organizations that you have affects your bottom line. This is especially true in liability cases. What you're attempting to do in all cases that you're putting together a corporation, what you're doing is you're hedging your financial bet. You're trying to keep within your budget, and you don't want to be punished if you miss. So what you're worried about, what you're looking to have not happen, is to end up with personal liability for the organization's debts. Now, we'll learn later that that's a disguised word for general partnership. We also want to make sure you're not liable for others' actions. Somebody driving a forklift in your place runs over somebody. You would prefer, if you were management, or even not management, not to be sued for that purpose. That doesn't mean you can escape liability. It's just a question of limiting it. And finally, there's the tax liability. We'll find out when we get to corporations that, except in certain cases, if you want to have a corporation and it's profitable, you're going to end up paying double tax. So on that happy note, we're going to the sole proprietorship first. A sole proprietorship is just what the name implies. You want to sell lemonade in a corner at a lemonade stand, and you sit out there hoping someone will buy it. You're a sole proprietor. There's nobody else working in the business, nobody else doing anything in the business. It's only you. Now, you may need to file a document, but normally for sole proprietorships you don't file any. But if you have the Joe Blow lemonade business and your name is not Joe Blow, it's Larry Smith, then you need to file in Texas an assumed name certificate showing that Joe Blow is really Larry Smith, but he's known by the name Joe Blow. So people, if they need to sue you, can know how to find you. And actually the law provides in the state of Texas that if you do not file and you assume a name in the assumed name certificates, you don't file that, then if you sue and lose, you could be awarded a penalty, a damage for what it costs you to find the assumed name of the person. Its tax benefits are simple, and actually I ought to get this up on the screen for you. Its tax benefits are simple. You're running your own business. If you get earnings, they're going to be taxed as income in your taxable year. If you lose money, then you may be able to deduct the loss from your taxes. The last disadvantage is a personal liability one. There's words for debts and torts. Debts are obviously what they are. Everybody knows what a debt is and what you didn't want to have in school. On the other hand, torts are a wrong that is done by one person to another person. And you could be liable for both personal liability for debts, if you borrow money to run your business because you need more lemonade mix, yeah, you're going to be personally responsible for it. Same is true of torts. If you run over that poor guy a second time with his truck, loader, unloader, you're going to be the object of the lawsuit. Hopefully you'll have insurance. That brings us now through sole proprietorship, that was all that was necessary, to partnerships, and in particular, a general partnership. One second. Okay. A general partnership is really easy, and actually, so you know now, and we'll get this done once, and I'll repeat myself again, it is possible you are already operating as a partnership. All it takes is two guys trying to make money, trying to make a profit, and you're a general partnership. And as we're about to find out, general partnerships are the last thing you ever want to be. So if you're going into business and it's a business that's got enough problem or potential money issues that could happen with it, you want to make sure that you have a better organization than just a general partnership. And the reason is, one, they're so easy to do, they're de facto. You and Charlie Brown again get into business with each other, and that is a general partnership. If no other shoe fits, the general partnership shoe will always fit. You'll always be the general partner. And general partners are always responsible for the debts of the partnership, so it exposes you to the most liability that anything can. And like I said, you don't realize it at the time, but you could already be operating as a partnership. And worst comes to worst, when you decide to dissolve with each other, you don't just say we're quits with each other. You've got to do something to show yourself to be done with your general partnership. So, and you'll see this come up at least one more time, and that is, whatever else you do, you don't want to be a general partner. One second. Okay, financial risk of a general partnership. All the partners are personally liable for partnership debt. Now notice, it's partnership debt. You're not liable for Charlie Brown's debt, even though he was your partner, as long as it's not associated with your partnership debt. But all partners are personally liable for torts of others if the partnership's resources are depleted. So what you've got here is, one, you got your general partnership still, and you're going to be personally liable for torts of others. Gets run over by a lawnmower, just to vary it. And a tort is committed because they're mowing the grass on your facility where you do business as a partnership. That tort you're responsible for, even if you didn't supervise the person. And also, you're only responsible if the partnership's resources are depleted. So if you still have money in the bank from the partnership, you're in fine shape, as long as you don't mind losing all your money. Forget that poll question. I presume, Helen, that the polls have already been up, or?
Okay, I'm going to activate the poll now.
That's just to get some background about you, which you can fill in while you're doing it. Unfortunately, it blocks out the screen, too. Hopefully it doesn't block out yours.
Okay.
Helen, can you move the screen around so that...
With you? Okay.
Okay. So we're down to the basic rules of the business organizations. And Helen, you can do the other two polls anytime you want as you go through here. The first is never enter into a general partnership. If you know you're getting close, just don't do it. And then choose the form of your business organization with care. That's what we're here to talk about, so you have some idea of what a choice is. Okay, so we had already a general partnership, and now we're going to go to a limited liability partnership, or an LLP. An LLP is a partnership that has one or more partners, but by statute, at least in the state of Texas, you have a limitation on the liabilities associated with it. So we're going to do what's called an LLP first, which is a limited liability partnership. And these are very popular because, one, the limited partner, let me see if I need it. Yeah. Limited partners have no liability. Excuse me one second, I think things got out of hand here. Yeah, this is the one that I was talking about that happens in the state of Texas in September 1. At September 1, there'll be a complete shield on people who belong to a limited liability partnership, an LLP. There's no personal liability for a partnership's contracts, no personal liability for torts of others unless they, well, those words, unless they knew of the misdeeds, were participating in the activity, always participating in the activity, or were supervising the person who committed. Those will be gone. Then there's flexibility in the management. All partners can participate in control without risking liability. And there are tax benefits. LLPs can pass through their debts and they can pass through their income to the partners themselves, and so there's only one level of taxation. That's the tax benefit. Registration is an LLP. What an LLP is a GP, general partnership, with benefits. You register for formation of an LLP with the Secretary of State. You pay a partner fee of $200 per partner. It's renewed annually without fail. Once you get into an LLP, you got to dissolve it to get out of it. You don't just stop paying on it. If you don't pay annually, then you become personally liable for the time period between when you stopped paying a partner fee and when you bring your partnership current. It used to be you had to carry $100,000 in liability. That's not true anymore, but you still need to use the firm name to include LLP or limited liability partnership. Remember again, LLP now will have a much greater importance than it did in the past, and that's because you've got a full shield. So again, we've gone through and we're ready to talk about an LP. We probably today will never talk about an LLLP, so I'm not going to waste time with that. An LP was the typical organization that was used for investors. It had two kinds of partners. It had a general partner and it had limited partners. The general partner did what anybody else would do who was a director. He managed the business. The limited partners had limited rights to talk about what they did or didn't like about what was going on in the business. So there's one or more general partners plus the limited partners. The limited partners had no liability except up to the amount of their investment. So limited partner got to get income, and that was spelled out in the limited partnership agreement. Excuse me. General partners were the ones personally liable for all partnership debts, and one or more general partners for a limited partnership. So limited partnership had the people who could get killed in liability, but usually they had very little in the way of assets. The limited partners, they put in the money to run the business run by the general partners. So how do you form a limited partnership? It requires at least one general partner and one limited partner. You need a complete written limited partnership agreement, which has to be filed with a certificate of formation with the Secretary of State, and you have to pay fees like $750, and you have to have a firm name. In this case, it would be limited partnership or limited, or an abbreviation like LTD. Advantages of a limited partnership. You have limited liability for the limited partners, and you can select to be treated for tax purposes as either a corporation or a partnership. That's what you do when you fill out your return, is you make that election. And then the IRS will treat you appropriately. So if you want to be treated as a corporation because of liability generally, you can do that, and the taxing authority will also treat you as a corporation if you so elect, even though you're really a partnership. So there's some disadvantages as well, as we pointed out before, especially if you're a general partner. You would be liable for the firm's obligations. The limited partners may be found personally liable beyond their initial investment if they exert control over the organization. So one of the things a limited partnership should never do is let their limited partners talk about anything except one kind of discipline, which is if you don't like where you are, dissolve. Okay. Now, generally, we have tax benefits for general partners, limited liability partners, limited companies, which we're going to come to in a minute, and LLCs over corporations. Corporations, their biggest problem is they're taxed twice. So you're taxed once and pay tax to the government. If you're a C Corp, and I'll tell you about this for 1 second, backing off for a second. A C Corp is a subchapter C company under the Internal Revenue Code. An S Corp is a subchapter S company, and they have different tax treatments. Right now we're dealing with C Corps. And what we're saying is they're taxed twice. One is a corporation itself pays the taxes when it makes earnings. Number two, you can only accumulate so much in the way of earnings in a company before you've got to do something with them, like pay taxes. And so the owners, I don't mean pay taxes, pay dividends. The owners, therefore, obtain money from the company because it's making money, and that's really nice, but it also pays taxes a second time on the same money. So the nice thing about LLPs and LLCs is they allow for pass-through taxation. In other words, the partners are taxed on their income, but the partnership itself is not taxed. So that brings us down to a limited liability company. Members generally are not personally liable for the firm's or other members' obligations. Now let me explain something. The word member really means something in this case. Instead of being a stockholder, as in a corporation, which we'll come to in a minute, you're generally called members if you participate in a limited liability company. So those members translate to stockholders, generally have no personal liability for the firm's or other members' obligations. So if another member commits malpractice, you're not responsible for that malpractice. Like limited liability partnerships, all members may exercise control without incurring liability, except agency torts. You would order somebody to go and hit Joe Blow. He hits Joe Blow and hurts him severely. You're going to be personally liable on an agency theory. Now, pass-through taxation is also allowed. As long as you make the election to be treated as a partnership, you'll be treated as a partnership. Or if you make the election to be treated as a corporation, you'll be treated as a corporation. You also have flexibility on names. You can have a president, even though you have members. Instead of directors, you have what's called managers. But you can have things called directors, as we'll talk about in a minute. And they are analogous to corporation businesses. Pass-through taxation we just talked about and said that was allowed. Now, let me give you one more caution, and it's one about malpractice. The next poll question has come up. Have you ever been sued? This is, again, background information.
Okay.
Okay, caution about malpractice. However the firm is organized, no matter what you do, one is always liable for his or her own malpractice. You can't contract around it and say somebody else can do it for me. That brings us to formation of an LLC. You file a certificate of formation with the Secretary of State. You pay your $300, and you have a firm name that must include limited company, limited liability company, or the abbreviation LLC. That brings us to the last type of business organization. But as soon as you finish poll question number 3. The last type of business entity is a corporation. A corporation is more complex in structure and more formal legal requirements are involved. That's because they've been around a lot longer. They have limited liability to everyone. So whatever the assets of the corporation are, those can be subject to liability. But otherwise, you don't usually have liability in a corporation unless you exceed its capital, in which case it could be bankruptcies and stuff like that. Corporation is a separate legal person. So it is treated like a person, a human being, and has a separate legal existence. So it has separate assets and separate liabilities from, for example, its shareholders. Its shareholders may have $1 million. The corporation may have $15.33. You sue the corporation, you get to collect up to $15.33. You don't get to sue for the millions of dollars that the shareholders may have. Owners are shareholders who own stock in a corporation. And so you want to, at times, do what's called pierce the corporate veil, which is to go against the corporation trying to reach its shareholders, but usually that doesn't work. So how do you form a corporation? And again, I'm going very quickly through this stuff. And we're on the last, like I said. You file a certificate of formation with the Secretary of State, in this case in the state of Texas. Directors are elected by shareholders. Remember, shareholders were the owners. Directors were the managers of the business. So it's directly elected by the shareholders to manage the company. In order to manage the company, not only do you need articles of incorporation or certificates of formation, but you also need bylaws which regulate when the corporation's directors will meet, when the shareholders will meet, things like that. So you have bylaws are typically adopted by the company. Legal requirements for annual meetings and voting, as I just said. You must pay a tax for the existence of the company and the amount of assets it has. And stock is issued to the initial owners or to raise further capital. So let's talk a minute about issuance of stock. Certificates of stock must include the number of shares of authorized stock in the company. It must state the stock's voting rights. This is true only if a class is without voting rights. Subscriptions are the same as an offer to buy stock. So a buyer becomes a shareholder by buying stock. It can be done through a subscription. Okay, certificates may include the stock's par value. A par value is the minimum value per share. You never sell shares for less than par value. Nominal par value, you can have that $1 a share, 10 mils a share. You have shares without par value, don't ever use them, because your problem is one of valuation. Are you buying something below the minimum value? Are you pricing your shares below their minimum value to buy something? That can make you personally liable, so you avoid those. Now, there is another kind of corporation, which is called a closed corporation. A closed corporation has, and certain corporate formalities have this, that, let me restate that. Certain corporate formalities may not be required. For example, you have owners, we talked about that, which are shareholders, and they can, in fact, in a closed corporation, they can run the company without having individual liability. They can be treated as shareholders, even though they're actually also acting as the directors of the company. So shareholders may enter also into voting agreements. They can agree with each other as to how they will vote, or who will have more shares than others for voting purposes. And you can also agree to restrict the transfer of the shares to outsiders. So we can agree, I and Joe Blow, my other shareholder, can agree that before I sell shares to my wife's ne'er-do-well brother-in-law, those shares that my wife has would have to be offered to me to buy first. So, some cautions about closed corporations. Shareholders' agreements need to be drafted carefully. They need to be that way because you may have to deal with a closed corporation that stopped being a closed corporation and you didn't know it. So you want to be careful to state exactly what kind of agreements you have between the parties with regard to shares. This is why it's so important that you see a lawyer when you're finally going to make a decision as to what you want for shares. Shareholders must treat the corporation as a separate entity. It's not your alter ego. You don't just take the company car. You don't just have the company buy you a car. You don't just have the company give you a promissory note. You treat it as a separate legal entity. Or otherwise, they will pierce the corporate veil, and you could become personally liable for what the corporation does. Now, majority shareholders, that's shareholders who own more than 50% usually of the stock. Some cases it's much higher than that. It can be any particular percentage. But majority shareholders may incur higher duties towards other shareholders. So some of the shareholders may be what they want to be. They may be able to boss everything around, but as shareholders, they become responsible if they waste the assets of the company, for example. Okay, so we want to talk to you a little bit, but not very much, about closed corporations again. This is on the slides, but I got out of order. Shareholders must treat, corporations have a more formal structure than LLPs, LPSs, or LLCs. Corporations are taxed twice. Remember, if you're going to be a corporation, and you can, then elect S-Corp status. Formation of a corporation requires less complex agreements among the owners. Corporations often provide a better structure upon which to build the organization. And corporations, LPs, and LLCs allow sale of stock to raise capital. At this point, I'll take questions.
Okay,
I have to read them now. Yes, Helen?
Does your presentation apply to states of Texas only?
Most states have something on the order of what I've described for Texas. They may differ in the details.
And the next question is, can convert from one organization to another?
The answer is you can convert, but you may have tax penalties. You can basically morph from one type of entity to a different type of entity, but there could be tax questions when you go from a corporation to partnership.
Okay, any more questions?
Aren't they on mute?
Yes, but someone's entering a question now.
Yes, see above. Yes. We are here. Oh, you did not describe an S-Corp. All an S-Corp, I'm sorry, you're right, I didn't. Thank you. An S-Corp is a corporation whose income, when received, is treated as if it was a partnership instead of a corporation. Not necessarily fully for tax purposes, but everybody gets, you don't have to pay regular income tax on the earnings and then pay it again when you get dividends. You don't usually pay a separate corporation tax for dividends. And so that distinguishes an S corporation, i.e. a corporation governed under the subchapter S rules of the Internal Revenue Service, from a C Corp, i.e. a corporation govern under the subchapter C rules of the Internal Revenue Service. Ash, hopefully that took care of your question. If not, I guess you can put up another one, or you can hit. So is there anybody else who has a question? Ash. So S Corpus and LLP? No. It works differently because it's a corporation. So it functions differently. And the liability principle, i.e. I'm not liable unless I do certain things, is for the most part the same, i.e. non-liability, but the taxation may be different. Depends on what's elected.
All attendees have been unmuted.
Ash, do you want to?
You can speak up.
Yes, so my question is that, so S Corp has all the benefits of a corporation, but its income is treated as a limited liability corporation. Is that what you're saying?
No, I'm saying probably the reverse of that. The income of a subchapter S corporation is treated as a corporation for tax purposes. But when you dividend that money up to you, then there's no second taxation.
Ah, okay. So there's no taxation on dividends.
There's no taxation on dividends. There are certain exceptions if you try to cheat the IRS, but that's the general principle. Habib? Was that you I just answered? No. No.
So my other question is, if you have a partnership and you don't make any income, do you always have to file your taxes annually?
I'm sorry, why don't you repeat the question? I think you're talking about consolidating income.
So let's say I have a limited liability corporation, and, you know, I'm making a loss, and I'm breaking even. Do I have to file my taxes annually?
You always have to file your return.
What about if I go dormant? I don't do anything for a year or two.
Okay, then it comes to what kind of an entity you have with regard to liability. But your dormancy just means that you shouldn't have earned any money or lost any money. So those would be normally taxed as an entity separately if they're a corporation. And if not, if it's an LLC and you're the owner of the LLC, then it would be, you could treat yourself as a partnership instead of a corporation.
Okay.
Anybody else have a question? Someone asked, I think, is Habib?
Yes.
So the choice of the organization comes down to liability and tax. No. It could be that because you want to raise capital and people are more used to certain types of legal entities, you could end up with an LP, limited partnership. You could end up with an LLC, which is becoming the most popular way of doing things. And part of that is dealing with what kind of income do you expect to get, what do you expect to have to disclose to other entities or to your other investors. So there could be investment vehicles that cause you to want to go a different direction. But again, you can always change from one to another. The key is you always want to have professional advice before making decisions like that.
So you said before that the world is moving from C corps to LLCs. Why do you say that?
Because we're seeing more of them coming out these days, and because there are certain things. I mean, what you're dealing with is a true partnership that can be morphed any way you want to with an LLC, but there are some limits statutorily for a corporation.
You have another question, Dave. Can an LLC own shares in a C or S corp?
Mine's cut off. It says, can it own shares in a C corp or an S corp?
Yes.
It can't own shares in an S corp. It can own shares in a C corp.
Okay.
I mean, you break the S corp election in certain. I'm sorry. When you have an S corp, it has rules for how long you can keep your S corp, and if you do certain things to your S corp, a little too complex to go into right now, you could cause it to elect out of its being an S corp, and it would automatically become a C corp.
Okay, we don't have any more questions, so Dave, we're going to end the webinar here, and thank you, Dave, and I want to thank the participants for their engagement.
Okay, Helen, if they have any other questions, you can forward them on to me, of course.
Yes, and I will be sending copies of the slides, so Dave's contact information is also on the last page here, and of course will be included with the slides. Thank you.
Thank you.
Bye-bye.